All right, this number 2, one thing that I guess I'd like you guys to be able to do is to recognize when you have a deferred tax liability or a deferred tax asset. The way they come about is that if expenses are higher for taxes than for book, that's going to create a deferred tax liability because you're getting a higher taxable or more deductibility for taxes earlier than book. And that's going to create a liability though because it needs to reverse back out. Whereas a deferred tax asset is the other way around, that the book depreciation or the book amount is greater than the taxable deduction, which is what happens here. In warranties, what happens is that for financial accounting purposes, what we have to do is estimate the amount of the warranty repairs based on the history and take that in the period in which the sale was made. For taxes, on the other hand, we take the warranty expense in the period in which the warranty was satisfied, which means that book accounting has a deduction earlier than tax. This is going to create a deferred tax asset. All right, so let's get into it. Let's go ahead and figure out what that deferred tax asset is going to be. What it tells me is that I have a $1 million warranty liability, and the warranty liability is the difference in the timing between taxes and book. Let's go ahead and look at that. So, when I showed you that 1 million, now that 1 million isn't the amount that this account needs to be. It needs to be put into tax dollars. And so what we need to do is take that 1 million times 0.25, and that's going to tell us how much this account needs to be at the end of the period, at the end of period 2. And they give me this information over here that says the tax asset is 223. The beginning balance was 223. And now that's my adjustment. It's what takes me from where I am to where I need to be. I'm always figuring out where I need to be on these problems. So this is 27. And now I can write the journal entry. Now I know taxes payable, and let's go ahead and write it out. What we have is deferred tax asset and taxes payable. Figure out what taxes payable are. Taxes payable is just going to be the 80 million times the 0.25. That's just going to be 20 million. And then we know what the deferred tax asset needs to be. It needs to be 27,000. Oh, this is going to get awkward. And so the tax expense needs to be 1,973,000. I'm hoping. But the point is tax expense is a plug. It's the way we always do it. All right. I think that's there's two main takeaways on this problem. First of all, identifying that this is a deferred tax asset problem, and that the timing of the deduction is different than with depreciation. And the second thing, being able to understand that you solve for tax expense. You get the other two and then you solve for it.